Okay, folks, welcome to Sunday Night Futures Live. Hope everybody had an awesome weekend. I have been spending pretty much the entire weekend working on the new members area. It's going to be pretty cool. I've been soliciting feedback from members. I've gotten some really good feedback, and it is being implemented as we speak. So a lot of changes coming. So stick around. I'll let you know when everything's updated and ready to go. And we are taking new members right now. Help support the channel through our friends over at TrendSpider. Use that link below. They're help sponsoring the show. Take advantage of our discount of 35%, bare minimum 35%, perhaps even more if you use our discount code link below on YouTube, link above on Facebook, and on Twitter. Or X, sorry, I'll never get over that. Okay, we have the futures market open. You are looking at a 5-minute view of the S&P 500, and we are opening up 0.12%. We have tight Bollinger Bands in orange, indicating expect some volatility here, whether it be up, whether it be down, we don't know. But it looks as though the path of least resistance is to the upside. This is now a daily view. Let's go to a 4-hour view. 4-hour view. And let's create an alert here. I want to know if we put in a new daily high or high. Let's go back to the 5-minute view. There come the sellers. Remember this time last week, we had lots of volatility due to the Ukrainian incursion into Russia, deep into Russia. And I mentioned back then, watch out for commodity prices. And we're going to go to a chart in a moment, the CRB commodity index and how it closed on the week last week and how it appears we are going in the month of June. In fact, what we're going to do tonight is we're going to talk about the monthly charts. I'll give you an update on the trade tariffs, and we'll talk about valuations on a historical basis. Not just here's where we're at current, but meaning where are we at relative to prior periods in history? And we'll be using the Buffett indicator for context. Let's say hello to those that are joining in. We'll let the futures settle out here. Mr. Pete, welcome. George, good evening to you. Sean, welcome. Mr. Tim, thanks for your feedback. Much appreciated. Talon, thank you, sir. Thank you for your feedback as well. And we have Paul. Thank you, Paul. All right, so we have a slightly strong open here. Let's take a look at the NQ, NASDAQ 100, the futures version of the Trip Qs. Pretty similar as to the S&P 500. Struggling here a bit. Small caps doing a lot better than the larger cap names. Now, I'll tell you, this is surprising to me. And the reason is that we saw bond yields close at the highs of the week last week. And I'm going to go to a chart in a little while. It's going to show you the trajectory of bond yields, and it's not pretty. And we're going to talk about the correlation of the 10-year yield relative to the S&P 500. And if we have time, we'll go into a couple of other symbols. But historically, when you have rising interest rates, the Russell 2000 struggles a bit. But this is the market that we have, not the one that we want. And at current, the Russell 2000 clearly outperforming the larger cap names. Let's check in with the mid cap names. Not as strong. I want to go back to the larger cap E-mini names. All right, so it looks like in this second 5-minute bar of the day that they want to go up higher. Let's check in with bond yields. Wow. Bond yields are no joke here. It's very surprising to see the Russell 2000 rallying as they are at current, with bond yields moving up higher. You can see they had a liquidity hunt back here. Or I should say more so a short squeeze on bonds, driving down yields. And now that short squeeze is over on the bond market and yields are proceeding up higher. Let's take a look at volatility. This is a 4-hour view. You want to stay very high level with your time frames on volatility because it's just that. It's so volatile. So, I was prepared to look at the volatility index and see prices on VIX higher. Didn't happen. You wouldn't expect it to happen. But given the fact that you have small caps rallying on strong bond yields and the larger cap names are lagging, I wouldn't have been surprised to see a bit of a divergence on volatility with it creeping up higher with the S&Ps kind of in no man's land right now. But we are at quote unquote oversold levels on stochastic. We're going to be going over the monthly chart of volatility in a moment. And really not to say how is the chart performing on a monthly time frame. It's just to see how the month is performing relative to last month. Have we put in higher highs? Have we put in lower lows? We just want to see how the trend is playing out. We have Denny here. Hey, Denny, welcome. Lee, welcome. Thanks, guys, for being here. Don't forget, like, subscribe if you would. I'd appreciate it. So we did the equities. We did volatility. We did bond yields. Let's talk about currencies. Let's begin with the dollar. The dollar is down relative to its close. In normal hour trading on Friday, and even lower than its after hours trading on Friday as well. Go to a 5-minute view here. Yeah, this is some serious selling here. You may get a bounce. I mean, it's a little bit extended to the downside at current. Solar Beam, great name. Thank you for the Sunday breakdown. You're very welcome. Thank you for being here. Appreciate it. Okay, so now that we've gone over the dollar, I want to take a look at the weekly charts of currencies because they matter. The dollar did manage to rally off the lows of the week last week. Could we be setting up for a W formation? Here's the left side of your W. Here's the pivot point right here. We just have higher highs now on the E-minis for the session. So there's our alert on the dollar. We did rally off the lows of the week. We're looking for a potential breakout on the Dixie weekly time frame. But let's face it, weak stocks tend to get weaker. That applies to currencies as well. So I would not invest on the hope that we get a breakout here on the dollar. I would wait for the breakout on the dollar and buy on the event. That's the way to play this, because the road to ruins is littered with people trying to anticipate a bottom in a bear market, and we are nowhere near. I know a few of you are probably laughing right now because I buy extreme overbought. Excuse me, I buy extreme oversold stocks and I short extreme over. Let's try that again. I short extreme overbought stocks and I buy extreme oversold stocks, but I have a criteria. You're in no man's land. You don't have an extreme condition here, one direction or the other on the dollar to go buying. Right now, you need an event. You need a washout, and we're nowhere near to having that. Could we break out? Sure, sure. But the trend is clear. It's defined. It's down. If I bought here, I need to buy with the expectation of being disappointed with my decision. Eventually, I will have my medulla oblongata, which I believe controls your speech area of your brain, working accordingly. So let's move on to Euro. Euro looking good here on a weekly time frame. I mean, it sold off the highs of the week last week, but it looks like it's setting up. It's consolidating along. What moving average is this in white? It's a 20-period moving average on a Keltner channel, or 15-period moving average. Let's check in with the yen. Yen had a bearish reversal bar last week. Not great price action, but we're opening up at current. I think the yen has to move up higher because the Bank of Japan is tightening because they have to. Tons of inflation over there. So we did currencies. Let's check in with, let's go back to the 5-minute view. Yen looking really strong here. Let's take a peek at gold. Gold down about 1/3%. We're going to talk about the monthly charts of gold in a moment. But gold opening down here. Let's check in with silver, which just had an outstanding week last week, and it continues to press up higher. No new weekly higher high yet, but silver really, really looking good here. Silver miners, if you take a look at what is it? SIL? What is it again? I own it. I've owned it for years. Completely drawn a blank today. SILJ. So that's the symbol for the silver miners. Let's take a peek at energy. Oh, you know what? I want to take a look at palladium. We own it. It did really well last week. Here's a chart of palladium. It did so well, in fact, I'm ready to pull the trigger on another tranche of shares of PALL. That's the Palladium ETF. You can see we have a very, very tight Bollinger Band squeeze setting up here. And last week, we began to fire off to the upside. Very bullish on Palladium. Platinum. Wow, that's really moving up high here. Another Bollinger Band squeeze. Bollinger Bands in orange, trading inside the Keltner channels. And we had another Bollinger Band squeeze fire off here in the precious metals space. So I always like to say that in trading, especially technical analysis, the markets send you signals. And the signal that the market is sending us right now, vis-a-vis the strength of gold, last week's breakout to multi-year highs on silver. Now you have platinum and palladium beginning to break out a very, very solid basis. They're telling you that there's inflation out there and it's only going to get worse. The bond market vis-a-vis the 10-year yield, the 30-year yield, 20-year yield, they're all saying the Federal Reserve is behind the curve. They should be increasing interest rates. The conversation in Washington about cutting rates to fight inflation is ridiculous. So I don't make the rules. This is just what the bond market is telling us. Now, if there was fear of recession, bond yields would probably be moving lower. We had great jobs data coming out that came out on Friday. The market ignored, including the bond market, they ignored the revisions of the prior 2 months. They only looked at that headline. So maybe later on in the week, as more people get lured into long bets to pull the rug out from underneath them, I'm not quite sure. As many people continue to short the bond market, maybe they'll get a short squeeze. I don't know what to expect here, but you have conflicting data. You have news coming out that inflation is coming down. You have news coming out that the jobs picture is good. The bond market is not telling us that inflation is under control. It is also not telling us vis-a-vis the commodity markets that inflation is under control. And vis-a-vis the job revisions for March and April, they certainly are not indicating that you have as strong of a job market as we had hoped for. So the market sends you signals. It's yours to ignore. We don't choose to do that here. But again, you trade the market that you have, not the market that you want, but you keep an eye on the exit door. It's a game of musical chairs at this point. Let's take a look at energy. Oil, I just spoke about oil prices, commodity prices doing well. This is last week's price action on oil. This is a breakout of a multi-week base, and it looks as though oil wants to move up higher. We're opening up here just shy of 0.25%. Let's check in with natural gas, which has pulled back off of its highs. But these past few weeks, we've been grinding up higher yet again. And last week, we broke out and we recaptured the 21 period EMA. So it looks as though the path of least resistance for natural gas on a weekly time frame is back to the upside. We were overbought. It came down. Now you can see vis-a-vis, I keep saying vis-a-vis. It's like embedded in my head now. Vis-a-vis, I feel like a smart person. Vis-a-vis stochastic, which is our momentum indicator that we are getting higher highs, momentum building here on natural gas, bullish. Lee, Bob, is there any chance you could take a look at a stock called KYTX? I'm up 64%. Sure. But what I need you to do is do me a favor, put it in the forum, or I will forget you and you'll hate me because it's very hard to keep track of these. And we're going to be changing the way we do this moving forward. Here, use that link, head on over. There's no credit card required. Takes 2 seconds to do. Just add that here underneath this feed here, right there, and you're good to go. Same deal. Yes, please use that link and put it in this form here, and I'll be more than happy to do that for you. Okay, so let's get to it. let's talk about the week that is ahead. And in terms of economic data, we have coming up wholesale inventories. Uh, that's only really an important number if you get a bad miss. I mean, if wholesale inventories build, that means that the retailers are going to have to cut prices to get product out. So only worry about a big miss here. If it comes in as expected, slight miss, slight beat, nobody cares. Tuesday, has to do with the small caps. Maybe they're front running this report in advance of Tuesday's report. This is the NFIB Small Business Optimism Index. Wednesday, you have inflation data coming out here. We get the CPI. That's the headline number. And then you get the core CPI. That's X food and energy, which the Federal Reserve states claims they don't pay attention to. So that's inflation on the consumer level. Then on Thursday, you get the producer price index, and that's the level of inflation at the producer level. Important is, are producers absorbing inflation, or are they passing it along to the consumer? Or in fact, are producers benefiting from lower inflation as stated by the federal government? We'll see. Thursday, we get initial jobless claims. That's a weekly report. And then on Friday, we get consumer sentiment. That's an important number. So that's the economic data coming out. In terms of earnings, not much. GameStop, which from what I understand has turned into a crypto play, they report on Tuesday. Chewy reports on Wednesday along with Oracle. Thursday, Adobe. That's it. Not much happening. Earnings season's been over. Ugh. As for the Federal Reserve, let's see what they're planning on doing. So, here's where we begin to go down the rabbit hole of the Federal Reserve and their need in this marketplace. And I would argue, as much as I don't like central banking or bankers, I would argue that they're doing the right thing. They're rolling off debt off their balance sheet. I do not think that Jay Powell is a bad Fed chair. You have to have a Fed chair. If I had to have one that's in there at the helm, he's certainly a competent man. So June expectations for a rate cut do not exist. It's not going to happen. July expectations, again, it's not going to happen. So the Federal Reserve riding in on a white horse is not going to happen until a bare minimum, and I doubt that this is even going to hold, is September. We have to pause here to ask, why would the Federal Reserve cut rates when you have inflation that has not met their expectations and you have the jobs market able to continue to create jobs, maybe not one might expect, but they're continuing to create jobs, not job losses. Why would they cut rates? Why would they do that? And I think that the only reason why they began to cut rates back in, September, was because of the election, to help Biden get elected. And yes, Jay Powell's a Republican, but Fed chairs really go into that job blind of party. They are all about the establishment, the independence of the Federal Reserve. They are in there to help the party in power. So he'll probably help whoever the successor is. President Trump obviously can't run again, but he'll probably help out the Republican candidate because they have a greater probability of winning unless the polls go absolutely horribly wrong for that candidate. Looking at October, I want to go back here and pause. We were above on Friday, above 60% probability of a cut for September. We have backed off. October, this is well above 80% last week. We have backed off. So you can always already see that the October number is beginning to melt away. Clearly, the September number, which was above 60, is melting away as well. So to me, if I see a number down in the 50 range on a Fed rate cut going out 3 months, that's a coin flip. Those are horrible odds. So the market does not have the Federal Reserve to rely upon at this point in time. But they do have somebody else to rely upon. We'll go to that in a moment. Let's talk about valuations here. We have the valuation vis-a-vis the vis-a-vis. I can't stop. We have the valuation tool, the Shiller PE ratio, also known as the CAPE ratio, right at a very close to a multi-year high here, just at 37. So stocks on a trailing basis are not cheap. They're very, very expensive. And when you take a look at the year-over-year earnings growth, this is at a FactSet. S&P 500 is expected to report year-over-year earnings growth of 4.9% for Q2 2025, which is below the estimate of 9.3 on March 31st. Sorry. So stocks are very expensive. They look like they want to go higher, yet earnings growth is going this way. That's a bearish divergence. Now, as for catalysts, what can keep the market moving up higher, the trade talks, there's been rumor out there that Chinese are complaining that we're breaking a deal, whatever. I am of the opinion that all Xi is doing is pulling President Trump along. I've stated this before, but it's worth repeating. I think that the strategy by the Chinese is to run the clock out. That 90-day time frame, if they decide to implement new tariffs, equities will go down, bonds will go down. You're going into the midterm elections, and it's going to take 60 to 90 days for the Chinese to feel the pinch. I mean, I think there's a lot of risk every day that goes by that we don't have a trade deal. Remember, that phone call that pumped stocks higher on Friday was supposed to have resulted in a trade deal. That was a headline that was out there. Stocks rallied up higher. There was no trade deal. Everybody should have known there was no trade deal simply because Trump called Xi or Xi called Trump. That's insanity. So I think that the Chinese are stringing us along, knowing that the longer that time goes by, the more difficult it is for Trump to govern and implement new tariffs during the midterms for him to retain power. Because if the Democrats get in, guess what happens? It's going to be impeachment hearing after impeachment hearing, and we're done for the next couple of years. So that's my take on it. I want to be wrong. I really, really want to be wrong here. But I think that at some point in time, it's going to hit the president that he's being led by the nose around, and he's going to have to make the call sooner rather than later than to implement new tariffs on the Chinese. Now, looking at the Buffett indicator, we remain overvalued. A few weeks ago, we were at strongly overvalued levels. So we're not as overvalued. We're just clearly overvalued. For a chart, right now you can see that we're 200%. 200%. The stock market is valued beyond the GDP of the United States. For visuals, here's where we are now relative to historical trend. Rarely are we down or below historical trend, and I don't expect to be there all the time, but a 2 standard deviation move beyond a historical trend, whenever that's happened, it's resulted in a very, very harsh sell-off that we really have yet to see in earnest, meaning a equity sell-off like the financial crisis, like COVID, like the dot-com bubble. We haven't seen it yet. And even when you take a look at the yield curve, which is not doing much. It's just consolidating here, not indicating that it wants to press up higher. It's hard to make the case that this automatically meaning the extension beyond a 2 standard deviation move means that you're going to drop like a rock. It means you could just consolidate a little bit. But I think that the threat of headline risk that's out there, or the threat of geopolitical events, whether it be war in the Middle East, war in Europe, war in the South China Sea, it's out there, and it's growing by the day. And were that headline to hit, we're in a very, very bad position in terms of valuations of the market. And just to illustrate, because I go over this chart frequently, but I'm not always putting into context where we're at on a historical basis. You could use this chart here, and this chart goes back to 1950, but I use ChatGPT to talk about past history. So back to 1900, I wanted to go before the Federal Reserve. 1900, we were at the Buffett indicator, 50%. We're at 200% right now, 50% of GDP. 1929, we know what happened back then, 70 to 80%. Think about it. One of the greatest stock market crashes ever. We had the Buffett indicator at 80%. We're at 200%. The Great Depression, we were 30%. World War II, max 45%. The Buffett indicator began back in the 1950s. So 33% was a historical low. Historical high during that era, 1968, was 87%. Reminder, we're at 200%. But you know what? We're in the internet age. Technology's taken over. You have all these fast-growing companies. Let's see where we're at relative to the 1970s, et cetera. Let's take a look. 81% was the high of 1972. 82, the high was 35%. Dot-com bubble, we went as high as 160%. We're at 200%. (2002) high 79%. 2007 118%. This was the financial crisis right before it, 117%. 2010s, the high during that period was 152%. Here is current day, what I like to call the everything bubble. The low since 2021 was 170%. Current valuations of January 2025, the indicators around 200%. A significant overvaluation historically implies muted future returns. That is where we're at current. And the problem is that the cost of money appears as though it's about to go up. Why? Let's check back the comments, see if people... Hey, the lovely Jody's here. Welcome, Jody. Good stuff. Thanks, Lee. Pretty easy, right? No strings attached. Bob, I have heard that some of the market being overvalued is based on AI taking jobs, saving companies. So I read an article today. It's an article off of, as a matter of fact, I could pull this up. It was a very interesting article that I had ChatGPT summarize it. Here, I found it. Oh, that's not it. Hold on. They may have changed the headlines. They do that sometimes for clickbait. So what the article was talking about was that there's so much in terms of AI build out, data storage that's already built out, but the utilization of AI is really concentrated in the large caps. And there has been no indication thus far that there's been any type of layoffs in mass. They may be isolated. I know that Business Insider, they laid off like 25% of their employees for in favor of AI. Here we go. I found it. Nope, that's not it. So I just told you pretty much what was in there. Let me go back to that article. I think they changed the headline for clickbait. And what is worrying is that they're building out all this data center uh, infrastructure, and it's not being utilized. Guess what? Those are depreciating quickly. That's the article there. I just put it in the chat. Um, so, in terms of productivity, in some companies, and this is stated in the article, that some companies are seeing between 24 and 27% improved productivity. So, it is a productivity tool, no doubt about it. It's for real. It's just that it's not being maximized as of yet. And I use ChatGPT all the time. It's not perfect. You can't rely solely on AI to run your business right now. Not with the version that's available to the public, and probably not even available to mid-sized companies that would be using, the higher end Chat GPT for $200 a month. You need much more advanced AI, and most companies can't afford that. Hangs for fun. Good name. Hi, Bob from Georgia. Hey, welcome. Any updates, insights on UNH? I've got two of those 250 leaps, June of 2027. I like the fact you went out so far. What drives me crazy is when people buy options and they go too close to the money. Uh, I like the fact you went deep in the money. Did you sell a deep out of the money call against that position, or you're just net long of the calls on UNH? I think longer term, it's a great trade. I think that we can go over the chart, but I think that we're showing a little bit of resistance here at this $300 per share mark. I would like to see a breakthrough that most recent high, and I think you're going to get a monster short squeeze on UNH. Right now, you have a little bit of resistance at the $300 per share mark. So I think you're going to get back and filling, back and filling. What I would do, since you're so deep in the money, you may want to consider selling a nearer money uh, covered call, a synthetic covered call, and just generate cash flow off of it. That's one way of maximizing that trade and minimizing any time decay, which you're not on a 2027 leap for June. You're not seeing much in terms of time decay. So in reality, if you sell a call right now going out 45 days, that's money in your pocket. Gotcha. Okay, I like the trade. I like it. If you would have told me that it was a 6-month option, I would have said I don't like it. The fact that you're out so far, I like it a lot. Moving on to our Treasury Secretary, I had the article up here. Somehow I lost it. So last week, and this matters. I want to try to find that article. The Treasury Secretary Scott Bessent came out and he said if the Federal Reserve won't cut rates, the Treasury will. So what does that do? It takes supply off. It should bring down yields. It should, theoretically. So I wanted to confirm it. I went over to ChatGPT. In May of 2025, quarterly refunding statement, the Treasury outlined a multi-tiered buyback schedule for May through July of 2025. Weekly operations of $4 billion in nominal coupons, 2 operations up to $2 billion. They're buying back tips, Treasury inflation protected securities. This in and of itself is not a lot. But here, the largest buyback ever executed. Now, this is dated. I question this date because it's yesterday, which is a Saturday, June the 7th. The Treasury executed a $10 billion, maybe the reporting date, $10 billion buyback of bonds maturing in July of 2025. That's very, very near term to May of 2027. That's long term. But still, it's only going to affect the shorter duration end of the curve. So, what did bonds do on this news? They moved up. Bullish key reversal. I'm going to show you a monthly chart in a moment that is going to kind of rattle your cage probably, because you take a look at this weekly chart here and you can see that we are in a very, very tight trading range. I would argue that we are setting up for a Bollinger Band squeeze here, which could fire off. My buddy just came to visit me. Which could fire off in either direction. But to me, with my eye, this wants to move up. So here you have a Treasury Secretary saying that we're going to take supply off the market, yet Treasury yields are moving up. Why might that be? Look no further than the CRB commodity index. Last week, before the news was announced of the Ukrainian attack on Russia, we had a very bad week the prior week. We broke down below the 50-week moving average. And that's a good thing for inflation. Then all hell broke loose last week. And I warned, be careful here. I kind of expected this week to start off with commodities behaving very, very strong. The question is, how do we close out the week? Do they sell off or do they break out? They broke out. So, if you're the Fed chair and you're looking at this and you're saying, okay, the jobs report came out okay on Friday. Yeah, we had the revisions down, Ruby. You know what? We're not in negative territory on jobs right now. I don't feel compelled with the CRB commodity index breaking out to begin cutting rates again. I wouldn't. If you're Scott Bessent and you're looking at what happened to bond yields after you've stated that you're going to continue with the Biden era Treasury buyback program and bond yields went up, that's a problem. And when you take a look at bond yields relative to the S&P 500, right now there's an okay correlation. It's a slightly positive correlation, 64% positive correlation. But once yields start breaking out, all of a sudden equities, as reflected here, begin to roll over. Here's the correlation. I misspoke. 69% correlation. But as you can see, there are times where when bond yields get going, that momentum gets going to the upside, S&P 500 goes in the opposite direction. We could be setting up for another move just like that. So let's take a quick look. I'm going to blow through these quickly. Monthly charts of the first CRB commodity index, monthly view. The last chart was a weekly view. New monthly higher high. The trend is up. It's not clear. It's not defined but it's strong. It's suggesting that we're consolidating after a breakout, and a rally up and through 316 spot 63 tells me that there's not going to be a Fed rate cut anytime soon. So we could be there within the next couple of weeks. Bond yields. This chart should have everybody's attention. Last month, this is a monthly chart now, we broke out. What have we done so far in June? Already in June, we have pulled back, retested support, and now we have follow through to be trading and closing out the week last week, and even in the pre-market now, as I speak, above the closing price of last month's candlestick. What that implies is that we are going up. As for bond prices, monthly chart, TLT, under a lot of pressure here, threatening a breakdown. We've been in the trading range for, my God, since 2022. If this breaks, God help us, we're going to be going down to 80 in a heartbeat. Tips. You heard it. The Treasury Secretary said, I'm going to buy tips. I'm going to buy tips. What are tips doing? They're at the lows of the month. They're down in the month. They were down last month. It looks as though we may even have potentially, this is a stretch, a potential double top here. That's a stretch. The dollar. Well, if the Treasury is buying back bonds, that's monetization of our debt. So I can't imagine a rallying dollar. Right now, we're holding support on the month. We do have a new monthly lower low, and this is what we primarily look for when we review the weekly chart or the monthly charts, is have we put in new continuation moves lower? Do we have a sign of a bottom? Maybe if we hold this 27 mark, RSI looks like it's trying to put up a defense at the neutral level at 50. Volume to the upside was very weak last month, and momentum is measured by stochastics trading down below 50. We know that rallies tend to fade. I would avoid the dollar. Volatility. New monthly lower lows. So for all my talk about the equity markets being overvalued, the VIX has put in a new monthly lower low. And even to put a nail in the coffin of my argument that I think that equities could see a breakdown here, let's do it. I don't talk my book. We have longs as well, but we are definitely realists. We could be rolling over on stochastics. If we close out the month with a new lower low, I suspect that we're all-time highs on the S&P 500. Easily. The Dow transports. Now, the Dow transports, they were crushed on the tariff talks. They had a failed breakout coming into the new year. We have our current candlestick trading above the close of last month, but no new monthly intra-month high yet. And just to take a look at a subcomponent here of the transports to get a vibe of what the probability of follow-through is, I took a look at the Dow Jones U.S. Containers and Packaging Index. You would imagine that if the transports are going to move up higher, that they would move up higher because this index is moving up higher as well. The problem is that it's not. At best, it's consolidating. And currently, it's down on the month. So a little bit of a divergence there. If we begin to see a breakout on this index, then that's kind of like a validation of the move higher on the Dow transports. As for the S&P 500, we broke support, a rising uptrend channel back here in March. We've had a rally back here. Momentum is moving up higher again. Good volume last month. The Dow Jones Industrial Average, it's holding on to support, which it gave up back here in April. It recaptured it by the end of May. We're holding above it at current. Triple Qs. Monthly chart looking good here. New monthly higher highs. Volume last month was good. Small caps. Very, very good price action here. Again, I'm surprised with yields threatening a breakout that the small caps are doing so well, but they are. That's a fact. And we have new monthly intra-month highs. Volume last month was not that great. The banks, if I had to buy one sector right now that's U.S. based, it's probably going to be the XLF. That's the larger cap banking names. It really doesn't matter if yields go up or down. They don't care. They make more money on the loans when yields go up. So they're good. They got every box checked. They play every angle. They'll be fine. The banks are looking very, very good. Technology also looking very healthy here. We do have overhead supply, but we do have a new monthly intra-month high in the month of June. Volume has been declining sequentially. That's a warning flag on the track. Discretionary names, not much to talk about here. No new monthly higher high. Inside month so far. Energy we've been watching. No new monthly higher high. We're holding support. Now here's where it gets interesting. This is a leveraged product, so don't pay attention to the percentage. This is a 3 times leveraged product. But let's go to EEM to put things into perspective. This is a non-leveraged product. This is where I would rather be right now. Emerging markets. They're cheaper relative to the U.S. markets and less risk right now. Take a look at Brazil. Granted, they have a Marxist ruler there, but if they're in a base, they're not going down anymore. You could sell puts here. You could sell calls against your long position. I think it's safer than U.S. equities. Take a look at, what the heck is this up here for? Oh, I thought this was pins. This is India. India just made new all-time highs last week, and they're cheap. Gold, looking toppy here. Hate to say it, but gold is looking toppy. I still own it, haven't sold it. As for the mining stocks, in Fuego, new multi-year highs. This is the GDXJ. We're at all-time highs going back to, not all-time highs, we're at highs not seen since 2013. Silver, major breakout this month. This is a monthly chart, major breakout. Currently for the month of June, we're up nearly 9% on silver. Silver miners on the month, up nearly 14.75% on the month. This is where the money's flowing. Right now at the Qs, the S&P 500, you have to hope that we break through that overhead supply. We probably will. But there's a lot of risk out there right now, headline risk. And if we get a bad event that occurs, those stocks are priced for perfection with year-over-year earnings growth going like this, down. Concerning. Bitcoin, last chart. Bullish key reversal on the month so far. Looks like we are going higher, potentially parabolic on Bitcoin. Bullish. Let's see what it's doing right now. Struggling on a daily time frame. Bullish still on that monthly chart. Let's do some chart requests. Let's try that again, Bob. Okay, folks, please give a shout out to our sponsor over at TrendSpider. Check them out. Automated technical analysis. We will be using TrendSpider for our analysis of your requests. Help support the channel. If you're going to use charting software, use the best. I call this my Bloomberg terminal for the average investor. So head on over, take advantage of my 35% discount code using the link below on YouTube, link above on Twitter, and get all the automation, back testing, AI, seasonality, analyst ratings. If you believe it, I don't use that much. Options, unusual options, events, seasonality. If I didn't mention that, insider trading. You got this right now. What's happening now? What are the thugs in government doing? Let's see what they're doing out of curiosity. This April Delaney is selling stock. FBIN, is she right? Looks like she's wrong. I happen to like that chart. Let's see if there's any names that we know here. Ro Kahana, I know him. Hewlett Packard. Let's go to the weekly chart. Guess he got bored of waiting. Merck, that's consolidating nicely. And he's selling. Good for him. He's losing. So head on over, please. Take advantage of it. Let's get to it. And let's go to the, I know a few people put in chart requests last minute. We will get to you. Okay, so Jody, we're just going to do, since we own it, I'm going to do SQQQ because it's just inverse of the TQQQ. So it's like going over the same chart twice. SQQQ, and we own this. For full disclosure, not looking wonderful. Big volume to the downside. This is a weekly chart. We put in new weekly lower lows last week. Let's go to a daily view. No new daily lower low. We appear to be holding the lows of May the 30th. We are forming a wedge formation. We're at the upper band of resistance. Would I add more here? No, I would not. Therefore, short-term bearish on SQQQ, more longer-term bullish on it. As for the TQQQ, short-term bullish, longer-term bearish because of the valuations. Next one up is KYTX. Kyverna Therapeutics. Weekly chart to begin with. Beautiful setup here. Very, very tight Bollinger Band squeeze setting up. Great volume last week. Obviously a breakout of a long-term consolidation. Here's the monthly view. I would want to take a look at the short interest here. Looks like there's probably a fair amount of them in there that are getting squeezed. Big move last week, I guess, on news. What are the insiders doing here? I'll get it right eventually. No insider activity. Okay. It's on a daily chart. Would I initiate a new trade here? No. Relative to the third standard deviation Bollinger Band, we're extended. I would expect a pause and or a pullback Very, very short term. Longer term, I'm bullish on the stock. As for resistance, I mean, there's not a lot of it. $3.72. Then after that, up to 409. There's not a lot of overhead supply here until you get up to 379 per share. I'm bullish. I think it goes up higher. May pause here, but it goes up higher. Uranium for Franklin. So this is the fractal trend lines. Let's take them off. All right, so looking at this chart here, I would say that we had a great breakout last week and that we need to see a retest of 3250. Doesn't have to be exact, just in the ballpark. And our alerts set. Here are our alerts. So that retest. And the added reason why I wouldn't go buying right here is that you have fractal resistance right above. Where is it? I just lost it. There you go, right here at 34.52. Doesn't mean you can't break through it. It's kind of difficult though, because you can see what happened back here when it hit it, pulled back. Back here when you hit it, you pulled back. All right, so that's the value of the automations on TrendSpider. Now, in terms of this is a commodity. So let's take a look at the seasonality. June, not a great month. July, coin flip. There's really not much in terms of seasonality to rely upon here. No trends per se that would give you an edge. So I would ignore it. Right now, I would focus on the trend. It's clear, it's defined, it's up. If in fact we do break above, and I think that we will, close above resistance at around $34 per share, I mean, we're going a lot higher. Let's go to a monthly view. Here's the monthly resistance level. I didn't draw this. That's the computer that does that. Up to around, let's call it 35 a share. Where do we close out? 33.64. So there's a sizable amount of overhead supply here. Daily view. Here's again the value of the automated trend lines. Looks like it wants to go up. Click your button, and you have immediate resistance right above. Doesn't mean it can't break above. You just don't want to initiate a new trade there. That's all. Okay, who else do we have? Paul, XOM. Now, XOM is interesting to me. Very interesting to me. We're at the bottom of this fractal trend line range. We've been holding it for a while now. This is a weekly chart. I think that we're probably going up on XOM. We saw oil move up higher. We saw the CRB commodity index breakout last week. I think oil's going up. I would be great with selling puts here. I'd be fine with buying the stock, selling some deep out of the money calls. But I think that it's a great time to begin accumulation because we've stopped going down. Daily view. Oh, I hardly ate today, and I got hiccups. Daily view, you have resistance immediately above at 105. So I would nibble here. I begin to buy on strength. As we recapture these support levels, nibble, add more. on the new version of the website, this is an idea that was provided by our members, was a conviction indicator, would show, much like a pie chart or a speedometer, the amount of conviction that we have in the trade. So when I say an opening position, perhaps that's only 10 to 15% of the trade, and that pie chart would reflect that. If we add more on a breakout, well, our conviction grows higher. Our buying becomes we grow more towards our intended allotment. If it's 100 shares, we buy 15. Then perhaps we'll buy 25 more shares. We build. So that's coming out soon. So that's how I would treat this stock. No reason to go jumping in with both feet right now. None whatsoever. Tesla for Mark. I think that Elon Musk put himself in a no-win situation, to be honest with you. I don't know how this stock is investable right now. Technically, it's a basket case. It's putting in lower highs. It broke support last week. It was down on volume. And, you could argue it was self-inflicted, but I don't think it – I think it was self-inflicted, but it was probably going down anyway, because you could see by these candlesticks here, they were selling into this strength. So I think that we would have been down anyway last week, but not this much. And I don't think that he thought. I think he had a battle of egos last week, and he screwed up. So I can't buy the stock. I can't. He's not seeing capital come in through autonomous vehicles. He's not seeing money come in from robotics yet. Tesla at current is a car company. That's what it is. When that revenue model changes, I'll revisit it. But right now, they're over-reliant on cars. The brand has been tarnished. Elon, as much as I respect the guy and like the guy, I think that he did himself no favors last week by making an enemy of the president. Especially when he already made an enemy of the Democrats. Not wise. Not wise at all. So in terms of technicals, weak on a weekly chart, inside bar and a daily chart, no new daily lower lows. That was a bit of a reprieve from the prior day's sell-off. I can't buy the stock. I don't see a reason to. Disney, I haven't looked at this one in a while. Weekly view, we're up and into a fractal resistance level here. I'm not a buyer. Doesn't mean it can't break out. I'd rather wait for the breakout and the close above 116.39. We close above that mark, I would buy the stock. And I hate Disney. And I don't hate Disney because of the product. I hate Disney because of their woke ideology and how they let it impact their business. I think shareholders should have thrown out management a long time ago. They didn't. I'm going to keep this active for a month or so. What else do we have here? So Disney, I can't buy it on a weekly time frame. We're running into resistance. It looks as though we are going to challenge further that resistance. Next resistance level is at 117. If it breaks through there, it's going up to 121. Then the question is, do we close the week out at 121 or do we fade? Do we fail? WHD, Cactus Inc. Bullish. We bounced off of, again, automated trend lines. I never reviewed this stock in my life. Never heard of it. But I do know in 2 seconds that we bounced off of support. We recaptured another one. We retested it last week, and then we got follow through. Bullish. I like the stock. It was up on volume, daily view. A breakout on both daily trend lines, on fractal trend lines. It's going up, bullish. WHD, I like it. PEP, this is Pepsi. It's a staple. I have comments to say about the daily chart. Let's stick with our tradition of going with weekly view. Weekly view, it's at the very low end of a trading range. Very low end. However, it reversed to close right at support last week and it was down on volume. Now, what makes me concerned that this may break further is that on a daily view, we broke fractal support and it looks as though we may go lower. I would do nothing here. This needs to get resolved. We get a close above 132.94. I'm a buyer of the stock. If we get a continuation breakdown, I would just avoid it. I wouldn't short it. I wouldn't buy it. I would wait for a close above 130. As a matter of fact, the heck with this. I want to draw there's my resistance, breakthrough. I want to go to seasonality. I want to take a look at also what the insiders are doing here. They were selling up until March. You've had some awards in May and June. I'm not seeing any selling here. Looking at seasonality. This is data going back 50 years. It's a little bit too much data. Let's go back to 2010. July is by far the best month out of the year. So according to seasonality, the stock should move up higher. This is data going back 15 years. So I would definitely keep an eye on this resistance level. A close above 132.86. I'm a buyer of the stock. Last one up is Mila. I'm losing my voice. Thank God this is the last one. Mercado Libre, don't buy it. Double top. This is a daily chart. Let's start with the weekly view. I'm still not a buyer here. It broke through the fractal resistance level and failed to hold it. Staples are not doing well right now. I think this could break down further. Just look at PepsiCo. I'm not a buyer here. It was down on volume. I think it can go down lower. I would avoid Miele. It's not a short, but I wouldn't buy it here either. You have a double top and a confirmation breakdown here. 2,501 spot 40, confirmed breakdown. That means you had a double top and a breakdown to new lower lows. Bearish. Folks, that's it. Thanks for everything. Don't forget about TrendSpider, link below on YouTube, link above on Twitter. I have a bunch of people on here tonight. Please like, subscribe. You know the deal. And everybody have a profitable trading week. I'll talk to you soon.